Hello there, it's Mark Sebastian, founder of OptionPit.com, and this is Trading VIX. Trading VIX, Spike Index, and the VIX ETPs. I want to remind everybody this is for education purposes only, should be considered investment advice. Options have risk. Consult a financial professional if you have questions. For those of you that don't know me, my name is Mark Sebastian. I am the founder of OptionPit. I was a trader on the SIBO and the American Stock Exchange, and then I started OptionPit. We are an education company that teaches traders to think like professionals. So here's what you're going to learn. We're going to talk about what is volatility real quickly, then the VIX, then spikes, then ways to trade VIX, ways to trade the VIX ETPs, and strategies for trading all of these things. So let's start with volatility. Volatility is a measure of movement of an underlying instrument over a period of time regardless of direction. The higher the volatility, the higher the movement or expected movement. When I discuss volatility, no matter how long to expiration, the number is annualized. So what does annualized mean? That means that no matter what period of time I'm looking at, it is a number that looks at things as if we were measuring over a year. So even if I'm looking at, what is the expected volatility for the next week, that number will be annualized. If I'm looking at how much we moved over the last 2 months, the number that I come up with will be a annual number, not a for that 2 months number. So if I say the S&P moved at a 20% volatility last month, that would mean 20% volatility annualized, not just 20% for the month. So it converts it to a number that looks at how it would act over a year, not just over that short period of time. Why? We get a lot more consistency that way. It's a more measurable number. So there are three main different types of vols. There are historical volatility, which how much underlying has moved in the past. There's realized volatility, which is how much an underlying is actually moving. And then there's implied. Now, what is implied volatility? Implied volatility is how much the market is guessing an underlying is going to move in the future. So the historical is how much has it moved. Realized is how much is it moving. And implied volatility is how much do we think it will move. So historical and realized can be used interchangeably. I tend to look at the term realized volatility as what's happened in the very recent past. So realized volatility is going to be like less than a month, is going to be, kind of how much we've moved. Historical volatility is, looking at months and months of data or years and years of data and kind of compiling that. So, implied volatility. What makes trading volatility, which is what I'm going to teach you to do, that's what the VIX is, different than trading a stock? And the answer is, over the long term, we know where volatility of a stock or index is going to go. We do not know where a stock price is going to go. There is this mean reverting quality of implied volatility, and all volatility really. Mean reverting means when it goes really high, it will fall, and when it stays really low for a while, it will get higher. Here is Apple stock. This is a picture that includes the close as of today. It's a 5-year chart. Someone will look at this and say, there are some patterns here, there's some mean reversion, but really look at that 200-day moving average. It basically just goes up. Right? Nobody thinks Apple is going to revert back to $13. Now this is the VIX of Apple. So without getting too deep, this is a measure of implied volatility of Apple. So what do you notice here? Well, that 200-day moving average does not have the same ups and downs. It actually looks relatively flat. It doesn't move around very much. It is volatility. It is reverting to its mean. So that's the thing, is a stock price can go anywhere and stay there. And while volatility can go anywhere, you can see Apple vol goes real high. It doesn't stay there. It reverts over time. So understanding this will help you with buy-sell decisions. If you just understand that implied volatility is low or high in regular options, that'll help you make some decisions. So the thing is, most traders think mean reversion is instantaneous. It is not. Vols, implied volatility, can stay low for a long period of time. Take a look at 2017. 2017, everyone kept waiting for vol to tank, and it never did. Or vol to explode, excuse me, and it never did. It barely did. It took basically, 2 months in 18, and they can go sky high. Look at August of 2015. Look at January and February of 2018. They can go high, and they can stay there for a very long time. What got a lot of people in January and February of 2018 was they kept expecting volatility to go right back down. It did not. So it's important not to have a recency bias. All right, so what's happened in the recent past does not mean that things will continue that way. Vol can go high, 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 and low, 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 and stay there for a very long time before it reverts. We're gonna look at a chart of VIX here in a little bit, and we're gonna talk about this. So what is the VIX? The VIX is the SIBO Volatility Index. And the purpose of the index is to gauge the buying and selling of options in the S&P 500. It gauges the cost of insurance. The idea is that when there's more buying over selling, generally the market is trying to buy protection. And when there's more selling than buying, the market is not out seeking protection. So VIX is up, cost of buying options, cost of insurance is up, and vice versa. Similar to the S&P, the index is not traded. A lot of people don't know this. You can't just go out and buy S&P 500. You can buy a basket of the stocks. You can buy a future. You can buy SPY. You can buy a mutual fund. You can buy an index fund. You can buy all kinds of things that attempt to be the S&P, but you can't just go buy the S&P. However, unlike the S&P, you can't even create a basket that will track VIX. There's really nothing that trades exactly like the VIX index itself. All right, it trades on its own. All right, it's its own thing. You can't go out and say, I want to buy the VIX cash index. It's impossible. All right. So the VIX is essentially an estimate of implied volatility on the S&P 500 options that has a constant duration of 30 days. What does constant duration mean? Constant duration means that the VIX constantly has 30 days to expire. So today the VIX had 30 days to expire. Tomorrow it'll have 30 days to expire. In 3 years it will have 30 days to expire. It has a constant duration. VIX is quoted as a price, but is really a percent. Volatility, despite not being spoken as a percent, is always a percent. So the VIX settled around 14 today. That's actually 14%. So a VIX of 10 is actually 10% annualized volatility. That means over the next 30 days, the market is expecting an annualized move of 10%. All right. So for the next 30 days, the market is expecting the S&P 500 to move like it's moving 10% a year. So here's the last 2 years of VIX, and what do you notice? I mean, you really get a full shelf of everything it's ever done. You get just really low volatility for the second, the second half, all of 2017 leading into 2018. 2018 remains low, and then boom. And then it stays basically in the 20s and 30s all the way until the end of April for 3 months. It then drops again before exploding in October. And we stayed high, as in basically above 20 from October, the end of October, all the way through till February of this year. We really had only kind of low volatility for about 2 months. So, generally speaking, the VIX negatively correlates with the S&P. When the SPX is up, VIX is going to be down. When SPX is down, VIX is going to be up. We saw that today. Today is April 9th, and the S&P was down about 17 points, and the VIX was up. On April 8th, 2019, the S&P was up a little bit, the VIX was down. All right? This makes sense, right? When we're selling off, movement increases. There's also the nature of similar movement against a lower number. There's other pieces of the VIX that also cause that to happen. And when that doesn't happen, that actually can be very telling. One of the things I always look for is when VIX is moving with the S&P, that scares me. So when S&P is up and VIX is up, that tells me something. And when S&P is down and VIX is down or flat, that's a very good warning for a bottom. When I see the VIX not doing much and the S&P is down, that typically tells me we're forming a bottom. VIX futures are the most successful financial product introduced in the last probably 20 years. They trade out 8 months plus weekly futures. Each month does trade independently, not like the structure of like SPX, which is slowly related through carrying costs. VIX months trade like VIX itself. VIX futures are correlated but not tied, whereas S&P futures are basically tied. All right, and VIX is in a contango north of 80% of the time. That means VIX is less than the near-term contract, which is less than the next one. We're going to look at this. And VIX futures are used as a hedge most often. So this is a contango. A contango. So the green line is the cash index. This is the April future. May is about 1620. June, July, August, September. You can see it goes out like that. That is how they are structured. This is about 80% of the time, this formation. And this is backwardation. This is from December 31st, 2018. The VIX is about 25.5. The January future is 24.25. February, March, April. So look at this. The April future at the end of the year was 21. And it looks like it's going to go out for around 14. Just noticing the difference in how these back months moved can tell you some things, huh? VIX Options. VIX Options are the most successful product introduced in the last 20 years. They trade out 8 months, including 4 weekly options. Each month, again, trades independently. And the underlying is the VIX future, not the VIX cash. So VIX futures track the VIX, but they don't trade with it. So for instance, April has about a week to expire. So the VIX goes up about a point. The April future will go up about 0.8 of a point. The May future will only go up about half a point. May has about 50 days to expire. VIX options and futures are a European exercise. This is why they don't correlate at 100%. They have a unique settlement procedure, all right, that's very opaque. And I always say don't trade VIX settle unless you're trying to trade VIX settle. At 30 days to expiration, they typically move at a beta of about 0.5 or 0.6 to the VIX itself. And as they get closer to expire, they track the VIX. So there is a weekly future expiring tomorrow. It moved almost lockstep with the index. All right, if I was going to throw in the weeklies here, I can do that. Come on. Go to VIX. Go to futures term. Live. And here's the weeklies. You can see where they are. The April future actually is underneath the cash index, settled 1380. VIX activity. You can see VIX options are extremely active. You know, this was taken kind of middle of the day. And you notice the average open interest is about 12 million contracts, average volume about 850,000. Thing trades a ton. You know, it's about a nickel wide most of the time for the markets. Spreads are even tighter. It is just super active. So let's talk about how to use the options. So recall, this is important. VIX options, the at-the-money strike is not the cash index, but that future. All right, so today, with the VIX at 14, the at-the-money for April options was actually 15. The at-the-money for May, 16. Right, look at this. This is from today. Right, so the at-the-money for May is 16. The at-the-money for August is 17. The at-the-money for April is 15. So in a 5-month period, we have 3 different at-the-money strikes for the same product. So I want to make sure I'm paying attention to what is at the money. This one's even worse, right? November's at the money is 11, December 12, January 13, Feb 14, March 15. So I think the primary way to trade VIX options is to be short and to use long put spreads in what's called a convergence trade. All right, so how do you do this? It simulates a short future, only you have capped losses with a long put. Has a little bit of time premium, but it's great for a convergence trade. So let me show you a convergence trade. At this time, I could have bought a September at-the-money put at, let's say the 15 strike, and if the VIX stays 11.5, that put is going to gain value just through the passage of time. That put is almost going to have its own theta to it, its own positive theta. As the VIX future falls toward the cash, my at-the-money put option in September is going to make more and more money just by holding it. I don't have to do anything. So this is January 2018, and this is November 2017. And what I want to point out is, look at the 12 puts. The cash index is 985. Should I be able to buy the 12 puts for $1? If I buy the 12 puts for $1, and then VIX stays at 985, how much do I make? How much do I make on this trade if VIX settles if I pay $1 and VIX settles 985? How much would I make? Well, my put would end up being worth $2.15. If I paid $1 for it, I'd make how much? $1.15. Name me name me another put that you can buy where if the underlying sits where it is, I make over 100%. It doesn't exist. Get it? And that's the beauty of trading these. I'll at the end I'll look at one. I look at one right now. All right, so let's look at the options. VIX is 1428. Regular April. Here's regular April. The April 15 puts are 95 cents. All right. Well, the April 14 puts, which are here, are 45 cents. What is 95 minus 45? 50 cents. So I can buy a 1-point put spread for 50 cents. Sounds normal, except if the VIX stays where it is, how much will I make? Well, my put spread would expire worth 72 cents. So I'd make 22 cents even if the VIX doesn't do anything. That is a convergence trade. You're paying 95 for the 15 put, selling the 14 put at 45, and you're potentially making a 50% return if nothing happens. And if it drops below 14, I can make 100%. That's not bad. Now let's talk about trading long. All right, generally speaking, I preach trading long when the conditions are correct. When we're going into a market that needs it. And however, if you want to have a hedge on, this is the way most firms do it, it is cheaper to buy a call and sell an out-of-the-money call. Because of vertical skew, which is the cost of out-of-the-money options relative to at-the-money, VIX call spreads are cheap. So here's an example. This is from December. This is December 2017, December 2018 options. VIX at the time was about was about 11, and I could have bought the 12 and a half 20 call spread for $1. So I can get $6.50 for the cost of $1 using a call spread. That is inexpensive hedging in my book. That is how I like structuring bullish trades. Ignore the actual yellow numbers there. Those were little positions that I had off against other stuff. And the key here is the ability to buy this call for $1.40 and sell this call at 45 cents. I'm paying 95 cents or $1 to get $7.50 of protection. That is inexpensive hedging. That is the way to set up a bull spread in VIX. So now let's talk about the new spikes, the spike index, or the SPY VIX. It is similar to the index. It's a similar index to VIX, but it's based on SPY. Because it's based on SPY, it updates dynamically. VIX only updates about every 15 seconds. It has a different settlement procedure designed to lessen some of the wild settlements VIX has had in the past. It is still lightly traded. It will get futures soon. It will trade more. Here's a chart of the spike. And what I want you to notice is that it trades a lot like VIX. It actually correlates to VIX something like 98%. So it is a lot like VIX, but it trades on SPY instead of SPX, and it has a different and less opaque settle. You know, here's kind of what it's looked like right now. The average volume hasn't been there. It's moved around though. It's got a few areas where there is some open interest. It will start trading, especially once they get futures. So make sure you add this. If you want to trade the VIX, make sure you add spikes to it. Stock symbol SPIKE. You know, and you can see how much it's like VIX. All right, so let's talk about the ETNs. You know, as VIX futures have blown up, so have the VIX ETNs. However, they have some unintended consequences. So I like to compare the ETNs to King Sisyphus. King Sisyphus was made to endlessly roll up a huge boulder up a steep hill. The maddening nature of the punishment was reserved for King Sisyphus due to his hubristic belief that his cleverness surpassed that of Zeus. Zeus, accordingly, displayed his own cleverness by enchanting the boulder to roll away from Sisyphus before he reached the top, which ended up consigning Sisyphus to an eternity of useless efforts and unending frustration. Thus it came to pass that pointless or interminable activities are sometimes called Sisyphean. The ETNs act a lot that way. So, for instance, let's talk VXX, formerly VXXB, formerly VXX. The VXX, or the iPath S&P 500 short-term futures ETN, attempts to replicate being a long VIX future with a constant duration of 30 days. Intent of the fund is to allow traders to get long or short near-dated forward value. The fund does this by constantly rolling out of the front month futures and into the second. So imagine you ran a business where you bought something for $16.10 and sold it at $15.50. How long would you be in business? you would not be in business for long. And that is how VXX works. So if you had bought the initial VXX, the first VXX, on the day it listed, how much would you be down? The answer is split adjusted. It's about $102,000. So someone's commenting VXX is gone. VXX is gone. Then it became VXXB, and VXXB is dropping the B and becoming VXX again. So so the point is that VXX and VXXB, now VXX, is still rolling itself to zero. The VXX should not be held for more than a few hours if futures are in a contango. If you just want to see if vol is going to go up that day, it's a good product. You know, it can be a good hedge against a long volatility portfolio, which there is such a thing. However, holding it all the time against a portfolio is a loser. You have to time your hedges with VXX. Time the hedges. Take a look. That is what the chart looked like until it went away. All right, but to make a point, here's VXX in the last year. No. Here's VXX in the last year. And here's what you notice. You know, someone says, oh, you can just short VXX and sit on it. Yes, but it will make some really wild moves where you can win the war, but the battle may kill you. So just like with being long VXX, right? Just like being long short VXX will win. If you get a face ripper like we had during this period, you're going to have problems, right? If you'd shorted on August 18th and held the whole time through the end of the year, you would have been exactly nowhere. So here's some different products that also trade. You've got VXZ, which is VXX, but it has a duration of about 100 days. So it doesn't drop as quickly. You have UVXY, which is levered. It's 1.5 times VXX. And you have TVIX, which is double VXX. Those guys can move. Take a look at a chart of TVIX here. I'll pull this up real fast. I mean, the thing makes, let me pull up the last 6 months. The thing can make some extremely wild moves. I mean, it went from, on December 3rd, it went from 34 and peaked out at almost 90. And now it's back to 25. Not so simple. Then there are the inverse ETNs. And I want to talk about this. All right. So there are the inverse ETNs. You've got XIV, ZIV, and SVXY. And XIV is gone. So let's talk about what can happen with these. Look at XIV. Look how smart all these investors thought they were. Oh yeah, I bought XIV and I just waited on it. Except this is what happened. SVXY, the clone. They lost 93% in a day. So nothing is that easy. When a trade becomes crowded, it's time to be very careful. So the key is there are smart, systematic ways to be long and short the ETNs. The key is to understand the curve. If one watches the curve, they would have been able to be out of the way of the XIV mess. It took Sisyphean hubris to blow up, and many did. The key is contango. All right, so generally speaking, I would only be long SVXY or short VXX when futures are in a contango. If they are not, I would not be short them. That will save you a lot of pain. How often do these clone? They clone a lot. So here's the quick summary. The inverse ETN, VXX and those ETNs are going zero. The inverse ETNs are not, except for when they do. IV and VIX are correlated. Bear and bull plays have very different structures, and VIX and spikes are unique. So I want to talk about this special class we have on Saturday. All right, on Saturday, I'm going to do personally a 90-minute class on how I see VIX trading right now. It's going to be me talking how to trade VIX for 75 minutes to 90 minutes. I'm going to talk about some futures and option trades I like in both VIX and VIX futures. I'm going to show you some trades I built. I'm going to show you how to look for good trades. I'm going to show you how I'm approaching VXX, how I'm approaching option trades that I like in VXX, things I would do, things I am doing. You're also going to get a free trial of the volatility newsletter that trades only VIX and VXX. And if you sign up tonight, you'll get a free 20-minute mentoring session with me or Andrew. All right? Go to optionpit.com/Saturday class. It's right here. It's on our events page too. But here is the link. And the cost is next to nothing. $147. And I'm going to really dig in. I'm going to teach you a lot of stuff on VIX, VXX, you name it. And you get all kinds of extra goodies for signing up if you do it now. All right, any questions before I close? Thank you everyone for coming. And if you've got questions, feel free to email me, marketoption.com, or call me 888-TRADE-01.